Hi everyone, we're here to talk about the escalating conflict between Russia and Ukraine. On Thursday, February 24th, 2022, President Putin declared the start of a special military operation in Ukraine. Blasts were reported in Kiev, the capital, and other parts of the country. Investors' concerns are centered around the invasion, the possibility of war at the border of the European Union, with unknown consequences on the loss of human lives, retaliatory measures from the EU, the US, and NATO through sanctions, and how this will all affect global assets. A potential Russia-Ukraine war would have global impact through various transmission channels. We will highlight three here: energy, consumer and investor confidence, and trade. Currently, Russia provides more than a third of Europe's gas supply, with some of it through pipelines in Ukraine. Nord Stream 2 pipeline is set to double natural gas supplies from Russia to Germany. This pipeline is 99% done, and Germany has called for a halt to the certification process. Oil is now above $100 a barrel, for the first time since 2014. Escalations can cause prices to increase further if supplies are disrupted. Ultimately, analysts think that the geopolitical impact on energy prices may be temporary, as it is not in the best interest of Russia, Europe, or the US to cause significant long-term supply disruptions. Also, we now know that the first round of sanctions are targeted at key decision makers in Russia and banks that finance the operations in these territories, and have left energy producers largely untouched. However, President Biden has vowed to hold Russia accountable and plans to announce more sanctions on Thursday. How this will affect investor and consumer confidence? This is the most difficult to quantify. In recent days, investors have flocked to safe haven assets like gold and US Treasuries. Major stock indices fell, with the S&P 500 falling more than 10% from its peak in January. Moscow's stock exchange halted trading, and the ruble fell to a record low against major currencies. Goldman Sachs looked at how global assets moved during sharp shifts in perceived political risk this month, and mapped out scenarios of where these assets will go from here as the conflict de-escalates or intensifies. In Goldman's worst-case scenario, the Nasdaq could be down 9% and oil could be up 13%. These estimates also assume that the Russian ruble is 10% lower. On the other side, if there is a meaningful de-escalation, the upside for Nasdaq and other major stock indices will range from 5 to 9%, while oil could be down 12%. However, history shows that the effects of geopolitical tensions tend to be short-lived. On average, it takes around 1.5 months for the S&P 500 to recover after bottoming out due to a geopolitical event. Russia's economy is highly dependent on exports of commodities. 63% of the main exports are fuels and energy products. So far, sanctions have not targeted these areas directly, as the EU is highly dependent on Russia. The US is less dependent. It is worth noting that 1 in 12 barrels of oil imported in the US comes from Russia. And according to FactSet, the combined revenue exposure of the S&P 500 to Russia and Ukraine is 1%. Even though the fear factor may remain elevated in the near term, history suggests that long-term investors are probably able to ride this out, as they have many others. For investors in our core Equity 100 portfolio, missing just the best 3 months in the last 10 years can cut your overall return by 22%. We know that uncertainty can be unsettling, but it pays to sit tight and stay invested. By pulling out of the markets, you may miss a few bad days, but also any recovery that follows.